Hello, nice to meet you. I am Dr. Kim from Richgo.
Hello, nice to meet you. I am Kim Ki-hoon from Richgo.
Today, I would like to discuss two ongoing issues that have been frequently mentioned: the problem of malicious unsold units and the seriousness of real estate project financing loans. I want to talk about how serious these issues are and why they are problematic.
Yes, I understand. Now, I think I should first explain what malicious unsold units are. There are two types of unsold units. There are unsold units before the construction is completed. Next, after the construction is completed, meaning the apartments have all been built, there are still malicious unsold units, which means they have not been sold. So, if we think about it in terms of products, we have invested our money in the factory to produce all these items. However, these items are not selling. Right. So, for example, if our friend Richgo is running a business, they must have invested quite a bit of money into making their products. And since the scale of real estate is so large, there is no one who can handle it solely with their own capital. We used a very small amount of our own capital and a significant amount of loans to create the property, but it's not selling. So, what will happen to our situation, Dr. Kim? In fact, could it lead to bankruptcy? It's heading towards ruin. In a word, this is what we call unsold units, and the precise term is completed unsold units. We usually refer to these as malicious unsold units because they are indeed malicious. As you can see, the number of malicious unsold units has now exceeded 16,000 nationwide. Do you see it now? It has been gradually increasing, but how has this climate been in recent months? It's steep. It is becoming more severe, therefore, the number of malicious unsold units is continuously increasing. As I mentioned earlier, due to the large scale of the project, loans are typically initiated from the very beginning with something called a bridge loan, right? So, what did Financial Supervisory Service Director Lee Bok-hyun say? Manage the risks of household loans in real estate project financing thoroughly. Right now, this is what we are discussing. Yes. Next, according to Korea Credit Rating, the net borrowing of construction companies has surged from 1.6 trillion to 4 trillion won in the first half of the year. What is meant by net borrowing? It refers to the money borrowed. That's right. The borrowed money has increased to nearly 4 trillion won, more than double what it was. As you can see here, with major construction companies like Shinsegae Construction, GS Construction, and SK Ecoplant, the expansion of receivables is leading to a sharp decline in financial capacity, making intensive monitoring of cash response capabilities necessary. So here, you can see the financial burden of receivables. There are construction receivables where the work has been done, but the payment has not been received. And then the receivables, including unbilled construction work, have increased sharply. This indicates that construction companies are currently experiencing poor operating cash flow. Now, construction companies are increasingly expressing concerns that problems are continuing to escalate. But this issue is not limited to construction companies. Let's think about it for a moment. Who are the participants in the process of building an apartment? First, there would be the construction company, right? So, who else could there be?
Since money is needed, funding will have to be borrowed, and the financial sector will be necessary.
That's right. Are there specific places in the financial sector?
There are various factors such as low withdrawal amounts, the second financial sector, and capital.
And there are securities firms as well, right?
There are banks as well.
The more this happens, the more expensive it will be, right? That's correct. However, if you look at the related news now, the financial institutions that provided the loans are continuously facing issues, and the problem is that they are even resorting to tricks. I will explain this a bit later. Now, if you look here, this is nice credit rating. It indicates that there is currently downward pressure on the credit ratings of major real estate project financing entities such as Shinhan and Korea Capital. So, as you can see, here, the exposure to real estate project financing, or the risk exposure amount, indicates that if the capital companies that have heavily engaged in real estate project financing do not improve their soundness through capital expansion, their credit ratings will likely decline.
Does not improving soundness imply that it was operated in an unclear manner?
It's not that, it's just that there is no money. They need to expand their capital, so financial institutions must have their own funds to operate. However, they provided loans for real estate projects, and now they can't recover those funds. Therefore, Financial companies have regulations that require a certain level of capital expansion to ensure capital soundness. However, since we are heading into a dangerous situation, right now, we need to quickly revise the soundness regulations. As you can see here, when we remove the effects of the election preparation fund classified as accounting profit, the net profit significantly decreases and the return on total assets has drastically fallen. Additionally, in the case of Korea Investment and Securities, there has been a weakening of the funding capacity for domestic real estate project financing, leading to a downgrade in its credit rating. Moody's has changed the outlook for Korea Investment and Securities credit rating from stable to negative. This impact is now affecting even the securities companies. And Moody's has downgraded the ratings for these. So, what Moody's has focused on is domestic real estate project financing. Next, there is another huge bombshell. One area that I believe has a very high potential for explosion in the future is commercial real estate. Looking at Korea, the building prices are at an absurd level right now. Therefore, the scale of exposure to risks in commercial real estate has led to a downgrade of the credit rating from stable to negative. So here you can see that this amounts to about 5 trillion won. As of the end of the second quarter, the domestic and overseas real estate exposure is approximately 5 trillion won, which is about 64% of the equity. And domestically, it accounts for about 82%, while overseas makes up around 18%. Additionally, the bridge loans, which carry a high level of risk, represent about 12% of the equity. For these reasons, the securities firms have seen a downgrade in their credit ratings. And now, following the savings banks, the capital companies are also facing a crisis of exit. As you can see here, the capital companies have concerns about the inflow and the potential for defaults, amounting to approximately 2.4 trillion won. Additionally, the savings banks are nearly double that, totaling around 4.5 trillion won. So, if we combine the current scale of our business with the issues of entertainment and insolvency, it amounts to nearly 7 trillion won. It is currently quite significant. Therefore, not only savings banks but also capital companies are now facing a crisis of being expelled. This situation is reportedly unprecedented. This is the first time I am hearing about this being designated as a corrective action target. So now, following COVID-19, the economy is facing significant challenges, compounded by the issues in real estate project financing, which is increasing the likelihood of restructuring in the second financial sector.
It has been mentioned briefly before, but there are ongoing discussions about the risky tactics being employed to buy some time.
That's right.
So what kind of trick are they using?
Yes, I will explain that shortly. Also, as you can see, among the 51 capital companies, 11 have a delinquency rate exceeding 10%. For small and medium-sized capital companies, as of the end of June this year, the delinquency rate for real estate has soared to between 30% and 50%. So right now, the situation is extremely dangerous. The delinquency rate is between 30% and 50%, which is truly alarming. However, if you look here, savings banks are also engaging in some tricks. Recently, there has even been controversy over genuine sales. What the savings banks are saying is that the losses from bad loans in real estate project financing could amount to a maximum of 3.9 trillion won, roughly around 4 trillion won. There are discussions about whether this is indeed a genuine sale. Furthermore, in the case of savings banks, the proportion of bridge loans, which carry higher risks at the early stages of a project compared to the main project financing loans initiated when construction begins, is significant. Bridge loans are used when purchasing land at the very beginning of a project, which inherently carries high risks. These loans account for more than half of the total project financing exposure. For securities firms, real estate bridge loans make up about 20%, while capital companies are at 30%. In contrast, savings banks are at a staggering 50% to 60%, indicating a very high level of risk. So, what was said here at NICE is that starting from the second half of this year, as the auction of sites with concerns about caution and insolvency progresses, the proportion of sales from less viable sites will increase. This means that losses will occur during the sales process, and the scale of these losses will grow. This is what has been discussed. Furthermore, as you can see, There have been controversies regarding parking transactions during the recent process of handling insolvency through funds, which is a kind of trick. If such unconventional sales increase, the normalization of real estate project financing will be further delayed, and the reserves that need to be accumulated will also increase. What this means is that the limits of these tricks are currently at this level. So, what exactly is this trick? If you look at it, savings banks are selling off bad PF loan bonds at prices higher than their book value, corresponding to the proportion of their investment in the PF normalization fund they invested in, thereby unfairly recognizing excessive profits. So, assume it's worth 100 billion or 10 billion, but in reality, it could be worth not 10 billion, but perhaps 3 billion, 4 billion, or 5 billion, 6 billion. But what about this 10 billion? It was sold for more than the book value, at 11 billion or 12 billion. So what does that mean? From the perspective of the savings bank, this will be counted as profit. So this is completely absurd and a trick. The Financial Supervisory Service has conducted an inspection, and it is reported that Savings Bank A invested 90.8 billion won in the first fund of Asset Management Company B. The savings bank has reportedly sold its non-performing real estate project financing loans at a price higher than their book value, recognizing a profit of 6.4 billion won. So, in the end, what does this mean? They have essentially shifted this burden onto asset management companies. So, if we hand it over to the asset management company and the savings bank is making a profit, at first glance, does this savings bank look good or not? It might look good. It doesn't look good. Originally, I had these losses, but I wasn't reflecting them. And now I'm passing them on to the asset management company, right? So, in a way, what are the savings banks and asset management companies? Savings Bank A has invested nearly 1,000 won here. They invested their own money and then unfairly sold this at a high price to make a profit. So this isn't just a trick. Isn't this actually almost illegal? So this is what's happening right now. On the surface, it appears that they have sold off the bad real estate project financing loans, but it only looks that way at first. In reality, they are not recognizing the losses and are simply passing them along without addressing the issues. So these kinds of things are happening quite frequently. Now, as you can see, here they sold the PF loan bonds at a price higher than their book value, which means they unfairly over-recognized their short-term net profit. Since they made a profit, what happens to the delinquency rate? If I have non-performing loans, they will all be reflected in the delinquency rate. But by offloading these, the bad debts are removed, making the delinquency rate appear better. It looks like they are operating well, so they are packaging it that way. What do you think about this kind of trick sale? It's like completely covering your eyes and pretending everything is fine.
This seems to be a problem. I understand that the financial authorities are planning to conduct a re-evaluation of everything. If that happens, what will be the next steps?
Exactly. I think this doesn't make sense, and I believe that the financial authorities should thoroughly investigate these matters. Right? This doesn't make any sense. What I'm saying is this: if we consider it from another perspective, for example, if a plant is sick, we need to strengthen its roots, right? But what we're doing now is like this. If the leaves are wilting, we're just painting them green with dye. Meanwhile, what about the roots? They're completely rotting away. I think this is the current situation related to real estate project financing. So, to summarize once again, the number of malicious unsold units is steadily increasing, and this trend has been growing even more recently. And the risks related to real estate project financing are continuing to grow. This is causing problems across construction companies, securities firms, savings banks, and capital companies. The delinquency rate is also continuously increasing. And then, what else is there? They are currently hiding their insolvency under the guise of stability. But what is the problem? In 2023 and 2024, the government's issues became so serious that they resorted to special measures to actually support the real estate market. What is the role of the government? I believe that the government's role in real estate is to provide some kind of buffering effect to prevent a sudden drop when prices go down and to avoid a rapid increase when prices go up. Therefore, I don't have a strong desire to criticize the policies of 2023 and 2024, but look at the situation. In 2023 and 2024, there has been at least a slight rebound, hasn't there? So, what is the current situation? What about the issues related to real estate project financing? Problems are arising. It's getting serious, but it hasn't fully exploded yet. The situation is continuously becoming more serious. What I'm really worried about is that I mentioned there would be a turning point in September 2024, and if you look at various supply and demand data or transaction volume data, it has completely shrunk. According to the statistics, released most quickly based on the actual transaction data from certified real estate agents, it shows that the average price has been declining since August. I believe there is a very high possibility of a significant drop in prices in 2025. So, if the real estate market significantly contracts again in 2025, what will happen then? In the past years of 2023 and 2024, things were somewhat manageable. But if the market situation worsens again, what will happen to the real estate project financing issues?
So, is there no action at all from the government or the public authorities regarding these tricks in sales or anything like that?
That's right. We need to conduct a check and take action now.
If that doesn't happen, it seems like there will be a major explosion, as you mentioned.
So, it seems like we are just passing the bomb around right now. What the government hopes for is that the real estate market will recover to some extent, which would delay the detonation of these bombs or reduce the scale of the explosion. However, I think this is not easy to achieve. In the case of the United States, concerns about an economic recession are growing, and these factors are expected to have a significant negative impact on the real estate market in 2025. Therefore, this issue is not just connected to limit companies. It could also affect construction companies, securities firms, and all significant financial sectors related to construction. This raises a lot of concerns about the future.
Today we discussed the issues related to low withdrawal amounts in real estate project financing loans and the matters concerning time buying measures. In fact, it seems that the issue will continue to be a topic of discussion, but I believe there are certain aspects that we should pay attention to.
That concludes today's content. I will return with more good information next time. Thank you.